Good morning, it's Jeffrey Christian of CPM Group. It's Tuesday, the 17th of January, a little after 11 a.m. in the morning. Silver's trading around $24.22 as we speak. Gold's a little over $1,900. I wanted to talk today about silver inventories. I gave an interview today with Adrian Pocobelli of the Northern Miner. It'll be a podcast released this week. He was talking to me and asking me a lot of questions about gold inventories, and we got into a whole discussion about how central banks, some central banks, get involved in gold, trading as a national market maker and as an agent for companies within their country. And part of the discussion had to do with the intricacies and mechanics of commodities trading, especially gold and silver, but in particular in that instance, gold. And I made the point that a lot of people who are in the industry or the market are not necessarily aware of some of the mechanics. And the same is true with silver inventories. So I wanted to talk a little bit about silver inventories today. This is a chart, you've seen it before. We update it every year and put it in our silver yearbook. This is from last year's silver yearbook. And it shows the amount of silver that we estimate, that you can count some of it, that it's in COMEX warehouses or reported by the Shanghai Futures Exchange or the London Bullion Market Association or the ETFs. And you have a pretty good estimate of silver bullion coins because the mints report how much they produce on an annual basis since the 1980s when they started silver bullion coins. But there's this big blue area in the middle, which is estimated or implied unreported inventories. And it's a number that we've kept up. We made the estimate in the late 60s, early 70s as to how much silver was out there. And we've modified it as we've learned more over the last 50 some odd years, and we continue to modify it. But it's a big chunk. It used to be the lion's share, but the markets have gained transparency with the advent of ETFs and bullion coins, and the fact that since 2016, the London depositories are reporting their gold and silver inventories. But there's still about 1.6 billion ounces out there, which appears to exist in bullion form. And people ask about it. And it's that stuff that people just don't see because it's unreported. And one of the glories of gold and silver and platinum and palladium are that they are private investments. So you don't necessarily have reports as you do like, the amount of treasury bills outstanding or the amount of corporate debt outstanding or the amount of equities outstanding. With precious metals, it's private. And that privacy is one of the things that attracts investors and others to gold and silver. The existence of that 1.6 billion ounces, much of it, hundreds of millions of ounces for sure, maybe more than 1 billion of it, actually is owned by bullion banks and trading companies, which lend it to producers and processors and fabricators and manufacturers and financial investors and providers of financial instruments. There used to be a bank, Republic Bank. It was sold to HSBC in 1999. And Republic was unique for a variety of reasons. It was the Safra family's bank, and it had a proclivity toward precious metals. It was one of the major metals trading companies. It had a seat on the London fixes for gold and silver, and it was one of the largest lenders of precious metals to the industry, to everybody from refiners and producers to fabricators, jewelers, and electronics companies. And Republic would report on its quarterly financials its precious metals position, which was highly unusual for bullion banks. Most bullion banks, the precious metals are not differentiated. They're buried in the balance sheet. But Republic would report that. And I used to have this habit. Fred Bogart ran the foreign exchange and precious metals desk of Republic Bank. And they were probably the largest holders and owners of silver at the time. And Fred and I had a habit for several years in the 1990s to try to have lunch on the first business day of each year and talk about what we saw and thought would be likely to happen in the gold and silver markets. And I remember one time, in the early 1990s, CPM Group, the price of silver was $3.50, $4.50 an ounce. And we were saying the silver market's living off of inventories. And sooner or later, the inventory holders are going to want a higher price rather than just sell it at the market and to continue to supply those inventories to the market. And that could be many years from now, but at some point it's going to happen and the price of silver is going to have to rise. But it's years away. We took a lot of flack from people who said, oh, CPM Group is blindly bullish and the price, they said the price of silver would rise, and it's been 1 year or 2 years or 3 years, and the price of silver hasn't risen sharply the way they've said. So they really don't know what they're talking about in silver. And we said, well, if you had listened to us, we said this is many years from now. And it actually occurred starting around 2004, 2005, 2006. But I was having lunch one January with Fred. He's a really great guy. He said, Jeff, I happen to agree with you. I think that at some point the price of silver is going to rise and rise sharply. Now, Fred and Republic took a lot of criticism from silver conspiracy people because they reported how much silver they had in their quarterly statements. So they were a target for the people who would claim that the banks were suppressing the market. And Fred, I remember that year, he said, look, I'm the biggest short in the market because I hedge my silver. And people see that hedge and they say, oh, he's trying to suppress the price of silver. But I'm also the biggest long because my shorts are actually hedges of my price exposure for my long position. And I happen to agree with you, Jeff, that at some point in the future, we're not quite sure when it will be, the silver market's going to make a turn. Inventory sellers will become inventory buyers, or they will wait for a higher price before they sell, and the price of silver will rise. He said, and the funny thing is, despite what people say about Republic Bank, we'll be the first to know it because we're the biggest long, we're the biggest short, and we're the biggest lender in the silver market. So we'll know when the change is coming before all these other people. Republic Bank didn't stick around long enough. It sold itself to HSBC to see that turn of the market in 2005, 2006. But that was the case. Now, all of this is important because people look at these numbers and they say, oh, well, there's this static amount of silver in inventories and it gets added to every year, mostly in coins and ETFs these days. But this blue stuff, it's gone down and it's kind of been flat. And interestingly, you can see it went down in that period, 1990 to 2005, that I was just talking about. And it got to a point, 2005, where it was low enough that the price started rising. Insofar as bullion banks are the longs with maybe 1 billion ounces of physical silver that they own, it's in their own worst interest to suppress the price of silver. Now, I've explained this in the past. Bullion banks make their money the way they make money with currencies. Very small fees on large volumes of things. If you're lending out your silver and the price is $10 an ounce and you're charging 3%, you're going to earn 30 cents an ounce for your loan. If the price is $20, you're going to earn 60 cents and the profitability of your metals desk is twice what it was at $10. Now, in a court of law, motive is important. So if somebody went and said, look, these banks are suppressing the silver price, and the court would say rational people don't act against their own best interests economically. Banks have an incentive for higher price, not lower price. It's illogical, flies in the face of evidence. It flies in the face of the empirical knowledge of how these markets work. Now, but those intraday spoofing convictions, that proves that banks manipulate the market. Intraday spoofing by a handful of traders, a dozen or less so far have been convicted, does not indicate any concerted effort to suppress the price on an ongoing basis. Spoofing has an immediate effect on the price that might last a few seconds or maybe a few minutes. And insofar as some bankers have been convicted of spoofing, in those convictions, in those trials, the courts have determined several things. The spoofers didn't coordinate among themselves, even within their own bank. One person who spoofed the gold options market at Barclays Bank, in the trial where he was found guilty of doing that, it was determined that his colleagues on the bullion desk didn't know he was doing it. In the JP Morgan trial recently, it was determined that there were 2 or 3 people who were spoofing the market on an intraday basis. And while they knew that each other was doing it, they didn't coordinate their activities. People tried to use the RICO, the racketeering laws, and say these people were racketeering to suppress the price of silver by spoofing the market. And the RICO charges, they were acquitted on. No, they weren't even talking among themselves. But spoofing has nothing to do with an ongoing concerted effort to suppress the price. And if you understand that banks make more money at higher prices, you've just lost the motive for suppressing the price. There's secret payments from the Treasury. No, let's be honest. That is a hypothetical that is highly unreasonable, and there's absolutely no evidence to prove it. It's the ranting of a paranoiac. It's not evidence that would hold up in a court. Okay. So that's a kind of interesting thing. And I thought it would be good to talk about it, because this metal, this 1.6 billion ounces, some of that is static. It's held by investors and it doesn't move for years and decades. Some of it came out of bullion bars and went into ETFs and coins over the last 20, 30 years. And some of it, a lot of it, actually churns constantly because it's coming in from mines and refiners, and it's going out to fabricators and coin manufacturers, bank manufacturers for mints and jewelers. There's another topic I wanted to talk about, and again, I've talked about this before, and that is that COMEX silver inventories. And the level of COMEX silver inventories do not really have an effect on the price. You hear this stuff about how we're down to 33 million ounces of registered inventories on the COMEX, silver inventories, and that's going to have an effect on the price. And I've shown you charts in the past where you can see that actually the higher the inventories have been, corresponded with higher prices, and lower inventories corresponded with lower prices. The correlation is positive. If you want higher prices, wait until you see COMEX inventories rising. That's an indication of a tighter market, believe it or not. I don't care what people believe. I only care what can be known. This chart shows you the deliveries in the silver versus total open interest. And you can see that most of the investors and other participants on the COMEX are looking for price exposure, price discovery, and price hedging capacity. They're not looking to take delivery. The next chart I have shows you a similar situation where you can see the same data in percentage terms. And you can see that back in the 80s and 90s, there was a lot more of the silver actually, the open interest actually taken delivery of. It was about 10%, 5 to 10, 5 to 15, sometimes it would spike up to 20% in a particular month. But as various producers and refiners and fabricators, users of silver, changed the way they processed their silver, either sold it or bought it, you saw a sharp reduction over the course of the 90s into the aughties of the percentage of open interest that was taken delivery of. Those industrial producers and users stopped using the COMEX as a terminal market through which they would pass through the metal, and they started selling or buying their silver in different ways. So the idea that silver inventories are going to run out on the COMEX and that's going to lead to a higher price is nonsensical. You wouldn't believe it if you knew how the COMEX worked. That's all I have today. We are working on our gold yearbook. It'll be coming out at the end of March. Silver yearbook will follow at the end of April. PGMs at the end of the year. You can go to our website and learn more about us. You can pre-order those reports at our website now. You can sign up as a retail investor program client, or you can buy other research and reports. I'll talk to you Friday. If you're in the Northern Hemisphere, stay warm. If you're in the Southern Hemisphere, enjoy it. And we'll be talking on Friday.